welcome to the Greater Texas Podcast. This is a podcast about building a better Texas. As Texas has fantastic growth, we, on a monthly basis, will interview a leader from the area and talk about what that growth means and how it affects us. I'm Sean Bukowski. I'm the principal of Bukowski Law Firm, where we protect your commercial real estate assets from dirt to disposition. This month, we have a fantastic guest. He's the Vice President of Commercial of Harmony Bank out of Dallas, and it's Marino Orlandi. Mo, thanks so much for being here. Really appreciate it.
Hey, great to be here. Thanks for having me on, Sean.
Awesome. Well, let's get started with a little bit of background. Tell us, you grew up on the East Coast, is that right? Or where did you grow up?
Well, I'm a Midwest kid originally. I moved around a little bit, but I was born in Milwaukee, Wisconsin, went to school on the East Coast. So I went to Columbia undergraduate, New York University for my master's, my MBA, worked there for a few years, and then came back to the Midwest and spent most of my adult life in Chicago.
Gotcha. First of all, how did you like New York? I lived there for a couple of years, and I thought it was pretty fun. When you're a young man, it's a young man's game, right?
for that stage in my life, it was a lot of fun. But
right.
When you realize you want to buy a house and have other goals, it gets to be
right.
gets to be very challenging, very difficult. But no, a lot of fun.
Right.
Met some good people, some relationships I still have to this day.
Gotcha. Awesome. And did you work between undergrad and grad school or no?
I did. Yeah, I did. But believe it or not, I spent before I went to grad school, out of undergrad, I did work in IT for a little while, believe it or not.
Wow. Okay.
I worked at IBM. I realized sitting in a cubicle all day wasn't my thing. And then I went back to business school, and I was fortunate enough where I went to school while I was working. So I got my master's at NYU Stern School of Business while I was working.
Oh, awesome. And after Stern, did you go right into banking then? Or?
Yeah, that's when I made the transition. Yeah, I use that as a segue to banking.
Gotcha. And then moved to Chicago. I was just last week. It was on the Michigan side, but off of Lake Michigan with my family, and it's so fantastic there in the summer. It was great.
Well, I was there last weekend for a family reunion, and 80 degrees and 78 degrees. Never felt so good.
Exactly. And so did you work for a couple banks when you were in Chicago, or how did the Chicago years go for you?
Yeah. I worked for most of my professional career. I spent at two super regional banks. First at Fifth Third Bank, where I was in commercial lending there and a team leader for 7 years. And then I spent another 6 years at PNC Bank. Gotcha.
And then what brought you to Texas?
Hey, got here fast as I could. Well, I think what attracts a lot of people to Texas, I think it's the economy. It's growing. I think Chicago, while it isn't declining, it's more or less stable status quo. You've got a growing economy here, a lot of energy, a lot of activity, and the fact that I could donate my snowblower to my cousin was a good feeling as well.
Yeah, no kidding. Well, I grew up in Michigan, and I enjoy going up there in the summer, but in the winter it is just brutal, and it's just not worth it, in my opinion. And the other thing, you mentioned the economies, and we're going to talk a little bit about this in the growing Texas economy, but I think both Dallas, Fort Worth, and Houston are both projected to pass Chicago in like the next 15 years, population-wise.
Absolutely.
It's just the growth is incredible comparatively, and a lot of Chicago, like a lot of places in the Midwest, it's just kind of stabilized their population, right? Like it's not really, the economy's not really growing much. It's just kind of stabilized, right?
Correct. It's you'll hear it's up 1%, down 1%. They're kind of teetering on basically being flat for the last several years, and and that extends to the economy in general, right? Population's been flat, economic growth's been relatively flat. So while it's better than declining, it isn't growing either.
Gotcha. All right. So you've been in Dallas. How long have you been in Dallas, Fort Worth area?
August will be 4 years.
Oh wow, excellent. And how long have you been at Harmony?
I've been at Harmony about 2.5 years now. When I initially started, I was with First United Bank, and then made the transition to Harmony, which I really like because they focus more on real estate, which is what I love to do.
Gotcha. Well, let's talk about that. So tell us what you're doing at Harmony now in that area, in the real estate area.
Well, as you mentioned in the intro, I'm the VP of commercial real estate. Do a variety of transactions. I focus on, CRE, CRE transactions. I also do owner occupied real estate, but I'll work in our legal lending limit is 20 million. So I tend to work with small to medium size builders and developers. Yeah, that's probably my bread and butter, and that's probably 75% of what I do. I also work with real estate investors. I have several clients that own rental properties, and I finance those for them as well.
And still doing in this, I know there were some lenders that pulled back from the investor side property, but you guys are still lending out on the investor side?
Yeah, we are for rental property. We have gotten more selective. I must be honest with you. We do look for existing clients. We're more inclined to do them because we have a relationship. What we are mandating is a deposit relationship. In the past, we may have just done the transaction, but now we're looking for them to keep a deposit relationship with us as well. And we're looking for, of course, them to put more equity in than we were, a couple of years ago.
Right. No, I think that's when I've talked to a lot, a fair number of people, and on the construction side, for example, it's very hard for people to get out of the ground right now. And one of the reasons, obviously interest rates, and then the loan to value, I guess loan to construction values are just, in the 50% is what I've heard range. I don't know if that's sort of consistent with what you guys are looking at, or.
Yeah, for loan to cost, we're looking at 50 to 60. We will do 60% for really strong clients, or where there's a relationship, or if they're a new client, if they're bringing a significant amount of deposits, we'll look at 60%. I mean, I did a deal at 65% recently, loan to cost for new construction. So, but everything else, all the stars aligned, and everything else looked good with that client.
Right. Are you guys pretty asset agnostic, or is there asset class you specialize in, or?
We're not crazy about retail, although we've done a couple retails, but those were on the lower end of the loan to cost, less leverage. And we did do one. I did do one office transaction, believe it or not.
Really? So was that a new construction, or was it a purchase?
No, it was a purchase. It was a purchase and renovation, but it was a stabilized building. Again, an existing client, so there's a relationship there. Well-heeled client, the sponsors had a lot of financial wherewithal, so we felt comfortable, doing that deal. But I guess if we were targeting things, the housing related, I did a 22-unit apartment building, multifamily, which is good because the population is growing throughout Texas, particularly here in the DFW market. As you know, I know you do business here as well, Sean. So
yeah. For sure. And are you mainly focused on the DFW market?
Correct. Or a DFW connection. So if I've got a sponsor that is based here in the DFW and they want to purchase properties in San Antonio or somewhere else in Texas, we'll do that deal for them. But I don't focus on Houston or San Antonio or Austin. We got to be a DFW connection.
Gotcha. And what's sort of the popular, if you have somebody that's an existing customer coming in, can you talk about like sort of the general terms, like what are the years, what are the rates you're looking at now, kind of in that range?
Yeah, what we're looking at is, let me think of somebody I just quoted recently. Yeah, I was just talking to an investor the other day. They're looking at purchasing a couple of rental properties. We're looking at 65%, loan to cost. We looked at that. We did a 5-year term, 25-year AM, and we were 8.25. So we range between very high 7s to mid 8s, depending on deposit levels and just other factors. But 8 is a good round number when I have for discussion purposes.
Right. And that makes sense. And I think now what we've seen too, and you mentioned this a second ago, is that, there's just more scrutiny than there was 5-6 years ago, right? And so the borrower profile has changed a lot in the last few years.
Yeah, absolutely. It's tougher for newer guys to get into the game, because the equity requirements are higher. They've got to put a bigger downstroke into the deal. I have come across a few smaller builders though, where there's a fair amount of activity. I've got individuals that have owned land for a while, and that land's appreciated, and that's helped them because we can count if they've owned the land for more than 2 years. We'll look at loan to value, so we can give them a lot of equity value that they've got in based on land that they may have inherited or may have just owned for a long time.
Well, that makes sense. Interesting. All right, well, let's talk about what's going on out there, what you're seeing. First of all, are you seeing a lot of deals, or has it slowed down this year up in DFW?
Our deal flow has been pretty good. It has slowed down somewhat, but I'm busy. I think because we are lending, and that word's getting out, and some banks have just completely closed their doors. Yeah. So that's helped us a little bit, and I think it's affected our space a little bit less because I work with smaller, builders want to build. I work with smaller builders, and they want to somehow find a way to do their project, and I don't focus on the big high rise, $100 million projects. I mean, I'm doing a $2 million project, $3 million project, and that's my world.
That's, you said something that kind of struck a nerve because this has been, obviously a tough couple of years, but right. I always say deal junkies got to do deals, right? They can't, nobody makes money just sitting around doing nothing, right? Like, and so, and frankly, the two things I hear most when talking to clients and everything is there's very little debt out there and there's not a lot of equity out there. And as a result, it's hard to get things started. So it's great to know that you guys are still doing deals that you are. In the last 2 years, lenders have taken the brunt of the ire just because the rates went up. Not that you guys can control interest rates, right? But sure. That's what where people are focusing a lot of their ire. What do you see as the future of interest rates? I mean, obviously, we're not going to get back to 3%, but what do you think?
What we are expecting? I mean, earlier, we go to their banker briefings, and we've attended a briefing with the Federal Reserve Bank of Dallas. At that time, at the beginning of the year, they were expecting 2 rate cuts this year. They have not cut rates at all this year. So the hope is they may do 1, and because it's an election year,
25 basis points though. I mean, if they do,
maybe 25 basis point cut. Yeah, that's what we're looking at for this year, and inflation still hasn't gotten completely under control. So I think that's the other side of the coin, and that's what we keep hearing at our updates on why rates haven't dropped maybe as much as anticipated earlier in the year.
So maybe 1 this year. Have they said anything about next year at all? Like, I mean, I know it's, who knows, and things can change in 6 months, and plus, like you said, we have an election in November. But
yeah, the next meeting's in July. So the Fed has their meeting end of July. So they'll talk about what they expect for the balance of this year. If speculation and it's purely that.
Right.
I think it depends on who wins the election. While it's supposed to be non-political,
right?
Reality is that the president and who's controlling the White House has something to do with it. And I feel that if Trump wins, he's going to want to do it and take credit and say, "Look what I did for the economy." If Harris or whoever ends up running from the Democrats wins, they may do it less aggressively, but I think there's still some pressure since it will be a new person, it won't be Biden, the new person's going to want to make their mark, and give themselves a chance to get elected. So I do feel that there'll be some pressure to do something there in terms of interest rates, because that's what's really holding things back. I don't think government stimulus is going to be the way to grow the economy. It was during COVID. And I think that was kind of a mixed blessing, as we're finding out. So I don't expect to see a ton more spending. I think spending levels will remain high, but I don't expect that to increase. I think there'll be more pressure on the other side of the coin on interest rates.
Makes sense. Yeah, I was up in DFW last week and meeting with some folks, and what you just said is a theme I heard over and over, which is things are so tight. People are reserved, they're holding back, they're not doing a lot of deals, which we've seen, a lot. And they're kind of like waiting for the election to happen just for some certainty. Whoever wins, at least there'll be certainty. I don't totally get that theory because, I mean, for the real estate industry, I mean, is it going to change that much? I mean, or for the economy in general? I mean, maybe it does, but I don't know. The fact that people, I think it's just, basically, I think it's kind of an excuse, right? People are like, oh, let's get some certainty from the election. Well, you can do the deal now. It's fine, right? Of course, I just want deals to be done. So, I mean, so I'm a little biased in that.
Hey, I'm in your camp too. I get paid to do deals. I don't get paid saying no. I get paid to make loans. But right. I feel like it affects the stock market maybe more than real estate. So when you think about it, so my belief is that, let's go. Let's do deals. But as I've said, Sean, you raise an interesting point you're kind of touching on indirectly, is there's going to be some pent up demand. So a lot of projects have been sitting on the shelf a while, and I think it's forcing people to kind of redo their economics and see can they find a way to make it work, maybe a little bit more time to get more investors involved, somehow find a little more equity to make deals work. I think banks may be willing to accept slightly lower margins too. We make money on that interest rate spread, so we may rethink our piece of the puzzle as well. And so I do feel like more deals will happen. Now, insurance hasn't helped. It's some other factors. So I bring that up to make them the new bad guy. People always blame banks. Exactly. I want to blame the insurance guy.
Exactly.
Like, wow, look at those insurance rates.
You're right. Insurance is crazy. Yeah. It really is, though. It's really gotten really high. And the everything. I mean, it's the truth that when I talk to clients, they're like, all right, so interest rates are higher. There's fewer lenders out there. Insurance rates are higher. There's fewer insurers out there. Equity is sitting on the sidelines. Things just aren't penciling, right? Like they were 5 years ago. And so, what's to be done? I mean, I think people are just, I don't know. I mean, something's got to give. We're 2.5 years into this, right? And at some point, something's going to have to give a little bit, right? Are you seeing sellers sort of reset cap rates and recognize sort of the new reality of interest rates and all of that?
Slowly but surely, yes. I think some sellers are living in the past, and they're expecting the glory days where they can get top dollar, and they're realizing even in markets like the DFW, which is relatively strong in comparison to the national picture, they're realizing that, okay, I'm not going to earn as much as I thought, and so that new reality set. I think everyone needs to recalibrate. Sellers, buyers, lenders, everyone who's part of the ecosystem, I think needs to recalibrate.
Let's talk about a couple of different asset classes. You mentioned that you guys. I was a little surprised when you mentioned that you don't like retail, because I keep going and hearing about how good retail is doing right now, and in general, especially like one person I talked to who's in retail says they can't build like 1,800 square foot units fast enough because the demand for retail in those size units is really high. And so I'm curious what you guys think about retail in general in the near future. And
we've done a couple of smaller strip centers. We're just looking for them to put more in. I mean, ideally, we'd want to do. Everybody wants industrial, right? The warehouse space and other things, and the industrial and multifamily have been more of our bread and butter. Retail, we've been a little more selective, and then office has just been maybe existing clients only. If they want to do something, and we've got a relationship.
I mean, do you see office bouncing back at any point? Or I mean, I guess the one good thing is we can potentially grow out of this issue, right? If we stop building new office. But so yeah, what is your thought on office?
That's an interesting one on office. The multi-tenant buildings we feel better about. Those large single tenant facilities, there's a lot more risk there. So the one deal we did do was a smaller multi-tenant facility, because they're seeing a little bit better demand, because as large companies downsize, as someone that needed 6,000 square feet decides they only need 1,500 because most of their workers are only in once a week for meetings and in a couple conference rooms. And as they sort of reshape their space to hotels, and as they adjust to this hybrid work environment, I think that's part of the piece.
Right. Yeah. I mean, everybody's got a theory on office, and my theory seems to change every week. And I mean, I like going to the office, so it's like if you don't have an office, it seems to me like it's such a good place to collaborate and go and work with people that it seems like it'll eventually rebound, but I think also hybrid is here to stay, right? And so
Yeah.
are you going to need as much space as you did before? Probably not. So
Yeah, and I think that's the trend. I mean, I'm a big fan of hybrid, although I'm in the office the majority of the time, but I like hybrid. I see a place for that. The complete remote, I'm a little skeptical of, maybe for certain job types or if you're a solopreneur perhaps, but I like the collaboration and a lot of things you mentioned earlier.
I'm sure there are a lot of young people watching this, but I have a nephew who's in college, and one thing I tell him is your first job cannot be remote. It has to be in an office space because you just don't have any idea what you're doing or how to work or what anything about the work life, right? Like, I mean, that's one thing that really concerns me, and we're getting off on a tangent here, but it concerns me for sort of younger employees, young lawyers. You don't know what you're doing. You don't know how to be a lawyer, and working remotely is just not going to help you as much as being in an office.
Oh yeah, likewise, a young banker working on his first real estate deal, complex deal. A lot of things come up informally. You don't necessarily want to schedule a Zoom call to discuss loan structure for a real estate deal. But if you're listening in, hey, sit and join me, and you can pop in someone's office, ask a quick question. A lot of learning happens that way too.
Yeah, for sure, for sure. All right, let's talk about. There's I forget exact number, but it's something like there's $2 trillion of commercial real estate debt that has to that expires by the end of 2025, or we're already in the process of some of that happening. But how do you see that happening? Because it certainly seems like the stuff that went under contract in 2019, 2020 at really low rates is now going to have to refinance, and is that going to pencil like they thought it was going to do?
Yeah, I got a call like that the other day. Someone's bank did not want to renew their deal, and they called me. We're looking at it, but if their rents don't align with their maturity term, that's where you run into a big problem. Because they don't have an ability to pass that on. For example, if you're stuck in the long-term leases with all your tenants, but your notes matured, now your costs have gone up, but you have to absorb that cost. And does the deal still pencil? And as we underwrite it from a banking perspective, we'll say your rents don't show you can support it. So unless they show the rent escalations that support that, it's a deal we won't want to do. Or the other thing, one of my mentors told me a few years back, equity solves all problems. So they can always put more equity into the deal, lower their loan amount, then the deal will pencil. But everyone's not in a position to do that.
No. Do you think we're going to see a rise in foreclosures, in commercial foreclosures?
And partly for that, I do. There may be a handful of opportunistic buyers. So if you have some people that are well-heeled and have a little, they've set some cash aside, or some investor groups that want to be opportunistic, I think they're going to have that opportunity.
When a traditional lender like yourself, when you're going through this issue, potentially you're willing to, maybe work something out with your lender, right? Does that happen sometimes?
Yeah, we do. We have some now. We would look to restructure their note. So as long as they're paying at a minimum, if they're paying enough to cover the interest charges, and we've done things where we've temporarily put someone on interest only, but we'd like to see a plan. Well, what is the plan? I mean, if they've got a plan where they can get back to whether it's attracting more tenants and being stabilized, where they'll have an opportunity to increase rents a little bit down the road, or we're just all waiting for interest rates to drop, but I don't know that that's necessarily
that's not the best plan in the world.
Yeah,
right?
I don't think that's a good plan, waiting for things to drop, because that could be 3 or 4 years from now before that happens, before they drop in a material way. So, what's the plan? Are you going to, you hear adaptive reuse? Is there a plan to do something different with the building, particularly if vacancies are part of the problem? So it depends a little bit on what the plan is. And we're more concerned about office perhaps than maybe we would be if someone's got a warehouse, or flex industrial that they could easily, there's a loading dock in the back and things like that could be, in fairly high demand. We talk about public-private partnership and how that could help. And just a thought, because I was in a meeting today about it, with all the plans around the convention center here in Dallas, and the development that is being sort of triggered by the government and by the tax base is having a positive spillover. I'm obviously not doing the huge convention center deals, but I'm finding other developers who want to be on the fringe of that and want to invest in the immediate neighborhoods around it, so they can be players. So I think that's something to watch and see, at least here in the DFW market.
It's interesting. So that's great. That's spurring. Sometimes you wonder if the convention centers will really spur that additional investment, but it sounds like it really is. That's great. Getting back to what you were saying, so if we have clients that are, in trouble with their lender and looking for some relief, the key is to come back to the lender with a plan, right? To be prepared and come with a plan. Don't just say, "Hey, we need help." It's we need help, and here's what we're going to do.
Yeah, correct. As well as a concrete plan on here's what payments I can afford, and maybe start there. But just coming with no plan at all and not having any clear ideas on what the bank could accept, because the bank's going to want as much. They're going to want you to make your payments as agreed or as close as possible. so they're not going to give you a number. I think if I'm a building owner, I'm better off being more proactive, thinking through my own economics and saying, "Hey, here's what I know I can afford to do."
Right.
And at least articulating that, and that at least creates a starting point for discussion.
Right. The other issue is, you mentioned this a little bit ago. Whenever there's times like this, there's also opportunity, and so there's buyers out there ready to purchase now. It's just a matter of whether they're going to give you what you want for your real estate, right?
Yeah.
But are you seeing a lot of folks out there that are looking for opportunity, the right opportunity in this market?
Yeah, I did. I've had one, and there are probably more. I've had one group where they purchased something opportunistically. So initially, it was a property they had approached about a year and a half ago for sale. The seller didn't want to sell at that time, but now they got it at a much better price and much better terms. So yeah, that does exist. And there's only so many buyers who have deep enough pockets to do that. But I think if people think creatively meaning how can they bring in more equity?
Right. Because at the bottom line right now, cash is king, right? So if you can come with 50% down, you're going to be much better off, and a lender's probably going to be much more likely to give you that loan with that much equity down, right?
Yeah, and the other piece too, Sean, and you being an attorney can appreciate it. I think seller financing can always come into play as well. And that could be a way to close the gap on a deal where, okay, the bank's only willing to lend so much, but as you look at your capital stack, maybe the seller keeps some skin in the game for a couple of years until better days are here to come, and they get part of their cash later.
I'm glad you brought that up, because it reminded me of a question that I should have had ready to ask anyway. But in an environment like this, where we've seen rapid escalation, fairly rapid escalation of interest rates the last few years, are lenders less likely to approve an assumption at this point than they would have been when interest rates were steady at a time for years?
Yeah, very, very much so. I'm not sure too many people are going to do an assumption now. That would be a tough call to make, unless it was maybe a deal written a year ago. But if it was done, 3-4 years ago, it's going to be a tough call.
Yeah, they're just not. There's no real reason for it.
Yeah, it just doesn't make sense from a banking perspective. We'll probably want to sit on the sidelines and take that deal.
Yeah, gotcha.
Maybe to help a client, if you're trying to help with a client, you can maybe break even on a deal if it's a long-standing relationship. But outside of that, I don't see it.
Gotcha. Well, I don't want to end this on a negative note. I mean, because like I said, there is still opportunity out there, and I assume while we're going through a dip here, you still see good things for the DFW real estate market in general, right?
I do long term. I think the Texas market will probably lead the country. I think we are better positioned than the 49 other states. We were less impacted on the downside. And I think we'll benefit more on the upside, when things do turn. I mean, the fact that people and businesses still want to move here And if we maintain the no state income tax and other sort of business friendly things that Texas is doing, I feel that's kind of really the secret sauce. Texas is more business friendly than a lot of other states. And as long as they maintain that position, I think that's good for the real estate market.
Yeah, I think that's the key. People and businesses keep moving here. I mean, yes, it's slowed down, especially to Austin in the last 2 years, but it's still a positive growth rate, and it's going to once things sort of settle down a little bit, I think it's going to just continue to grow like that. Like we talked about earlier, Houston and Dallas are projected to pass Chicago in the next 12 years. The projection I saw, Austin's MSA right now is 2.3 million people, and the projection I saw for like 2040, maybe it was 2050. 2050 was 5 million people. I mean, that's incredible. Wow. The growth. I know. Wow. And so, the Austin San Antonio corridor is developing into DFW basically. So I agree that in the long run, Texas will be fine. It's just, we got to get through, survive to 25, right?
Yeah, we do. Yeah, absolutely.
Gotcha. And you, and I assume Harmony has a rosy outlook too. You guys you're one of the ones that are still loaning, including to investors, right? So.
Yeah, we're lending. We're more selective, but we're lending. We want to be smart about growth. We don't want to get ourselves in trouble, but we're smaller banks. We're being nimble, but we are lending. So we're open for business. I'm open for business. We're doing deals.
Call Mo money, right? Call Mo.
If you need some Mo money, call Mo. I'm here.
That's right. Well, thank you so much, Mo. I appreciate it. It was a great talk, and I appreciate you taking the time to be here today.
Hey, glad to be here. Yeah, thanks for having me on.
Thank you very much for listening to the latest episode of the Greater Texas Podcast. Hope you enjoyed that conversation. If you'd like to hear some of the other great conversations we've had on this podcast, please go to BukowskiLawFirm.com. And when you're there, if you sign up for our weekly blog email, you'll be able to get updates to all of our latest podcasts. Otherwise, you can go anywhere that you watch or listen to your podcasts on a regular basis, and the Greater Texas Podcast is also uploaded there. Thank you very much.